Hello and welcome to the Commonwealth Market Update for November. My name is Brad McMillan. I'm Commonwealth's Chief Investment Officer. It was a great month. Much to the surprise of everyone who worried at the start of October, which certainly would include me, U.S. markets ended the month up over 8%, and international markets were up between 7 and 8%. This was actually one of the best months ever on record. And the question in my mind is why? And will it continue? Let's start with why. First of all, we had a terrible third quarter. There was terrible news in the markets. There was bad news from around the world. The U.S. looked to be going into an economic slowdown. China was slowing down. Europe had multiple problems. Everybody was worried. Everybody was scared. What all this led to was low expectations. The market was pulled down during the quarter simply because everybody couldn't possibly believe that things were actually going to be okay. But as it turned out, in October, the world didn't end after all. Look at it this way. Let's look at corporate earnings, which is really the basis of market performance. They weren't great. They're probably going to decline for the third quarter, but at the same time, they're much, much better than investors thought they would be. They're declining less, and much of that decline comes from a couple of sectors like energy, where the decline is actually good for everything else. The other part of the decline was weakness elsewhere in the world. And that's real, and it continues, but again, it wasn't nearly as bad as people had thought. So investors looked at the markets, looked at what they had done in the third quarter and said, you know what? Things aren't actually that bad. And they promptly bid prices back up. Now for the second part of that, will it continue? I would argue that we now have reasons to believe it might. The markets are now back technically in an uptrend, which is positive for the future. If you look at the risks around the world, they are receding. Let's look at Europe. The refugee crisis, while it's still there, seems to have been starting to be handled. China is not growing as fast as it was, but they do seem to have a handle on things. Here in the U.S., the biggest risk out there, the debt ceiling, has actually just gone away. So the risk picture is much better than we thought. Second of all, the U.S. economy, even though there are signs of a slowdown, and I believe that's real, is actually on very, very firm footing. The slowdown mostly comes from the rest of the world. If you look at exports, if you look at manufacturing, it's suffering from a strong dollar. And that, quite frankly, is something that's not going to go away, but it does seem to be stabilizing. That doesn't mean it's going to recover, but it means it's probably not going to get that much worse. And that's a relatively small part of the economy. The vast majority of the economy is based on consumer spending and domestic service industries by and large. And those are actually doing very well. We've seen some negative news. Personal spending and income dropped a bit, but at the same time, spending is matching income, and that means it's sustainable. If you look at the basis of the economy, we have consumer confidence holding firm at very healthy rates. We have the housing market hitting new highs in home builder confidence and moving ahead in home sales and home construction. We have new vehicle sales at multi-year highs. The important thing about house sales and about car sales is it's a multi-year commitment by consumers. You don't do that sort of thing if you're not confident. And that's exactly what consumers are. And even though we have seen job growth slow down, it still remains at levels that will improve the unemployment rate over time. So here's where we are. The markets are back in an uptrend, the news is much better than expected, and the foundation is solid. We certainly have risks to remain. Volatility is quite possible, but I have to tell you, I feel much better closing this month out than I did last month. With that, I will talk to you next month. Thank you very much.